I'm going to share my screen now. The thing I'd like you to remember is that this is purely for education. This is not meant to be financial advice on any level. I think that's important for you guys to remember. For those of you that happen to see my presentation that I did, I finished up about 2.5 hours ago. This is going to be very, very, very similar. I'll talk about a few things different here and there, but for the most part, it's going to be a lot of the same. So today, what we're going to do is we are going to talk about volatility. All right. I call this presentation a trader's guide to volatility. Okay. And it's interesting. I'll get into this, but it was really interesting that I think the last 2 days was kind of a really classic example of how volatility can go really right or volatility can go really, really wrong. And we'll talk about, a couple of the ins and outs. For the first time, usually I come out here and I say, hey, this is something for you guys to learn. And, I want to help. And if you're interested, come check me out. But I'm straight up selling a class on volatility at the end here. But it's inexpensive, and I really think it's worth it. So, and there are about 90 different ways to get your money back. So, and by that I mean 3. With that, let's get going. All right. Stock XYZ is trading around $320. A trader buys 10 XYZ November 310 puts on October 18th prior to XYZ's earnings. All right. The trader is ecstatic the next day to see that XYZ is down $10. All right. The trader opens his TradeMaster platform, or in this case it was TradeMaster, but we can look at it in Thinkorswim here momentarily, and they see this. Okay. All right. It's actually down 50 cents. You're saying, wait, the stock is down, and I'm long puts, and I lost money. All right. Probably sounds a little familiar, right? Somewhat familiar, moderately familiar. Yeah, it probably sounds super familiar. Well, I'll give you guys 5 guesses to figure out what stock this is. All right, and if it takes more than one, I will be sad. I'll be sad, and I'll be slightly depressed. What stock do you think this is? Apple. That's correct. Correct. So let's pull up Apple, and we can actually take a look at this. All right. We'll go to Analyze. We'll go to Apple. Think back. Oop. Think back. Again, Apple. And let's go to the 18th. All right. So here we are on the 18th. And, let's say we didn't play the weekly. So we buy the, we buy the put for $12. All right. Now just kind of pay attention to what happens to this the next day. Yeah, you see it's actually down. Even though the stock is below, ends up below where we were. Okay? And that is because, take a look at the implied volatility here now. All right? That's open interest. Take a look at the implied vol. All right? Notice the 310 puts, 41.79. What's the vol the next day? 31.06. The implied vol fell a full 10 points, and so it actually swallowed up all of the gain from delta and more. All right? And that's the thing about volatility. It is such a powerful factor, and yet it gets ignored by so many option traders. I've never understood it. I just don't get it. Okay? And yet it happens all the time. Okay? This trader was beaten by his or her lack of knowledge of volatility and its effect on a trade. All right? There are many other war stories with very bad and very good results. Let me give you an example. Okay? I was looking at, we'll pull up Thinkorswim again. I was looking at the SPY weeklies. If you guys, any of you guys read the blog, my blog, by chance? optionpit.com/blog. Well, anyway, I've been looking at this SPY strangle, okay? Yeah, SPY strangle. And it was in the weeklies. We were looking at this yesterday, okay? And I made a comment that I thought that the 120 straddle leading in the 119, 120 strangle, all right? We can look at the weeklies or we can look at the regulars, all right, was inexpensive, all right? And here's what I was kind of coming up with was that, the 120s were $1 and the 119 puts were, 87 cents. I noticed how inexpensive I thought that was. So you can see the strangle under $2. Okay? That's cheap. That's real cheap. Okay? Especially going into all this news. But at the same time, those vols had actually been creeping up the last few days. So watch. Look at the vols on this strangle over the next couple of days. Actually, you can't really. But, just pay attention to where implied vols are moving in the SPY. As we trade, they're getting higher and higher, right? So here we are in the second. Now, okay? So here we are in the second. Now, if you look at I can't hear. How can I unmute my audio? Turn up your speakers, okay? That's probably in your little, you see this audio thing? You probably have a thing like that. All right, so you have this thing for $1.92, $1.93, all right? I thought it was a little cheap, but, I always said things are cheap for a reason, okay? So we come on the third, and basically nothing has happened. And look, no, it does not need a dedicated proprietary feed. This program is called Think or Swim. So take a look at the strangle. All right, you'll notice that after today, even though the market's up, strangle's only about $1.30. Okay, I was on talking to somebody that I work with, and I was saying, pull the trades. All right, pull the trades. Vol is in. Okay, gotten completely smoked. Take the trade off. Well, he did, but he didn't. Okay, did not do enough. And then lo and behold, what happens today? Gee, you think this guy wished he had dumped his strangle? All right, he went from having basically $60 a strangle in his pocket to being out $60 a strangle. All right, or $50 a strangle. That's a $110 swing. All right. Now imagine you had 100 of those. That would be 110 times 100 times 100. Guy just blew $11,000. Okay? And that's because he didn't understand what was going on with volatility. All right? And, I'll talk about it, but we'll kind of really dig into something like this during the little class I'm going to be doing. But basically what happened was it turned out that his risk reward just wasn't there. Now, I wrote a lot about it on the blog tonight, so you can actually read it, read kind of more detail at optionpit.com/blog. All right? So back to the presentation. Volatility. All right, the truth is volatility affects income trades. It's really important in income trades. I could have shown you a very similar chart or a very similar situation for condors, butterflies, and calendars. Okay? Speculative trades, earnings, takeovers, really important stuff. All right? Earnings, that Apple trade, right? Then long-term trades, okay? Covered calls, protective puts, and collars. It matters which, what type of trade to set up depends on volatility. In a lot of ways, that volatility really matters. Okay? All right, so this is my my Dr. Seuss saying. Okay, I've got a very, very good-looking 10-month-old son who happens to love Dr. Seuss, and so I was sitting there and I just thought, I must have just finished reading Red Fish or One Fish, Two Fish, Red Fish, Blue Fish, and I was thinking, or maybe Hop on Pop. That would probably be more appropriate, And I was just like to think of this in like a cartoony voice, whether big or small, volatility will affect them all. And really, the basic point is, if you want to become a successful options trader, you need to know volatility cold. All right. Okay. All right. So let's take a look at a stock. All right. Someone's asking, thanks, and also a question, why don't market makers base their vol figures on volatility movements? That would be fair. I know it's not about being fair. The market makers base their pricing on supply and demand. You ever, how the Vegas casinos work when it comes to setting bets? Okay, you know how the line on, say, the Bears-Bills game this weekend in Toronto is Bears plus 6.5? I don't know why I'd know that. Yeah, so as line moves, as the risk changes, exactly right. That's what happens to volatility. As more and more people are going after a specific type of option, that's why market makers change the price. Okay, they can't just do it off vol movements because otherwise they would just get taken apart. All right, so, and we're going to get into this more. So, but the way market makers operate is purely on supply and demand. That's why that Apple trade got smoked. Everybody came in to sell premium, okay? And that's just it, is that volatility really affects price, okay? And price is what determines profitability, all right? Now, so they're just saying that market makers figured out. No, I can tell you as many horror stories about being a market maker as I can about winning as a market maker. There are a lot of times where we just got totally tooled on by big time paper. It's just the truth. We don't know what's happening as much as you don't know what's happening. And now markets are so tight that market makers themselves don't have a lot of the same powers that they used to. They really just don't have that kind of pricing power anymore. So it is just like a stock, you know? If market makers set price by supply and demand, why would volatility be a factor? Well, that's just it, is that volatility is really kind of the driver of prices, okay? Supply and demand, they have to have some way of managing that implied volatility and manage that supply and demand, and that is by the volatility. Now, there are times where demand or supply can throw things out of whack, okay? Or a particular order can throw things out of whack. And that's where understanding volatility can really matter. Or, demand in one area can throw things out of whack. Okay? So understanding what volatility allows market makers do is compare supply and demand on one strike to another, to another, to another, from a month to another, to another, to another. All right? It's in similar way to a line helps Vegas figure out where the supply and demand is coming. Volatility helps market makers figure out where supply and demand is coming from. I think that that should really I think that's the best way to think about it. It's where the New York Stock Exchange is trading a stock around a price, and price moves up with supply and demand. Market makers are trading options around a volatility with the volatility being determined by supply and demand. All right. And the thing is that since options are derived from a stock price, all right, then market makers can't use price as a determinant. Okay. So that's actually kind of the cool thing. All right. I think that should answer the question, but I can get into this more. This is something we can really dig into at some point. So, the point is you need to understand volatility cold if you're going to, just like you need to understand the price of a stock in order to buy it, you need to understand the volatility of several options in order to trade them. All right, now there are 5 factors that go into every pricing model. All right, the most complex to the simplest. All right, price, strike price, timed expiration, cost to carry, and volatility. Okay, every model. All right, now price. If you can't figure out the price of a stock, all right, I want you to leave and stop trading completely. Not just options, stocks. All right? Go and find a financial advisor and call it a day. All right? Strike price and timed expiration. If you can't figure those out, then please stop trading options. All right? Then find cost to carry. That can be a little tricky. Interest rates move around. Dividends can move around. But for the most part, you ought to be able to figure out what the general nuts and bolts cost to carry is going to be. Okay, you ought to be able to figure out what the general nuts and bolts and cost to carry is going to be based on what you're within a couple of cents. It's volatility that we don't know. It's the only thing we really don't know. All right, we don't know what it's the only factor we really don't know. What is the volatility going to be going forward? Okay? What is volatility? All right? Volatility is another word for the term variance. Okay? All you college statisticians have probably heard variance. Volatility is just a cool word for variance. Okay? It represents an quote-unquote expected range for a stock or index on an annualized basis regardless of direction. Now, when I say expected range, what I mean is it will be up to this point, it's probably not going to move more than this amount. Okay? So, for instance, if a stock has a volatility of 20% and it's trading $50, okay, in a given year, it probably will move $10 in $10 or less in either direction. So it will end up somewhere between. Then, what is expected range?
Welcome to GoToWebinar, Web Events Made Easy.
Did I lose sound there for a second? Can you guys hear me? All right. How long was I out for? All right. Is it all back? Did you miss anything? My voice changed. 30 seconds. Okay. Okay, cool. I got it. All right. Okay, so the basic point is that, volatility is another term for variance. I'm going to start there. Basically, variance means how much a stock is going to move on an annualized basis probably. I like to use the term probably, okay, as a general thought. All right, I don't think expected is as good as a word as probably. So a $50 stock with an implied volatility of 20, okay, or volatility of 20, will probably move, all right, $10 or less in either direction. So it will probably end up between $40 and $60, all right? But what does that mean, all right? And, what does expected range really mean? And are there interpretive issues, okay? And the answer is yes, okay? There are three kinds of volatility, all right? Current volatility, all right? Current volatility is crazy because it's hard to grasp, but at any given time, a stock actually has how much it is moving, okay? And that's what we're actually trying to trade. We're trying to trade how much a stock is moving, okay? How much is it really running around? We don't know, okay? And that's kind of what we're trying to grasp. That's what we're really trading, okay? Then you have implied volatility. That is the future volatility the market is predicting based on current trading price of options, all right? So believe it or not, when you're looking at implied volatility, average trading range, that's one way to think about it. Implied volatility is actually an output, not an input. Kind of interesting, right? All right, and it attempts to be forward-looking. All right, then we have historical volatility. And historical volatility is what has occurred over a period of time, okay? It's backward-looking. So if I was going to pull up Thinkorswim and we wanted to look at a chart, you look here and we look at something like SPX, and you actually can follow, the purple line is 10-day vol, and the green line is implied vol. All right? Kind of interesting. All right? And then, there are other ways to look at this, but this is one way. People look at 10-day versus historical. This is 10-262. So it's 10 in a 262-day trading year. So kind of, it's kind of interesting. But, there are guys that use this. I look at implied volatility a lot. I don't look at historical vol that much. I do care a little bit. All right? All right, so yeah, you can see historically, all right, this is interesting. Implied volatility is too high when compared to standard historical volatility. Yeah, I mean, historically it's been 2% is what we always said, was that implied vol is 2% higher than historical volatility. Now, Is that always the case? No. Okay. Does it feel that way all the time? No. You know, if things are directional, even a small amount of movement can seem, if direction and if volatility, low volatility in the same direction can feel like a higher volatility sometimes. It's kind of an interesting thing. So, you know, that's kind of the tradition. All right. Now, standard deviation. All right. These are all nice buzzwords. Standard deviation is annualized volatility over a non-annual period of time. And this is something that I use all the time. For instance, when I'm calculating the wings of a butterfly, I use standard deviation. When I'm trying to figure out my probability of profit, standard deviation. When I'm figuring out whether I want to stay in a trade, standard deviation. All right? And what it is the volatility times the square root of the days in days over a year times the price. Okay? Times the price. Now, here's the one thing. When I'm dealing with a period of time within 1 week, okay? So I'm looking at Monday, and I want to look at a period that ends on Thursday, okay? I use 255 instead of 365. Good question. Yeah, I'm good. Answering it right now. I use in time periods where it's within a week, okay? I use 255. So if I want to know 1 day volatility, if I want to know 3-day volatility within a week. Now, if I'm using anything that involves a weekend, I use the 365 number. Okay? I think that is the most accurate way to measure volatility. Okay? That I think it makes a huge difference, all right, in these short terms. It actually does matter, all right? In the long-term stuff, it kind of matters a little less. But for me, that is my general approach. And, you know, traders use this calc in several ways. So, you know, looking at this, let's pull up our Thinkorswim again, okay? And we can look, somebody pick a stock. Oh, you know, I just don't use the toss vol chart very much. When I look at vol charts, I do not use Thinkorswim. All right? If you want to know how to use, I use a product called Live Vol. My best, you know, I talked to a lot of guys, and by our best estimate, these guys currently have kind of the best vols out there. So yeah, when I want to see a chart of the SPX, you know, I'll look at, here's 30-day implied volatility to 20-day historical, or 30-day historical, 10-day historical. And then I'll look at 90-day vol and 360-day vol. All right, so this is really what I use to look at volatility for those of you that want to know. All right? See, I hold nothing back, guys. And actually, I was doing a presentation for Trade Monster today, and I thought their vol charts were better than what TOS had. At least from kind of a just looking at vols themselves, okay? So let's kind of, somebody pick a stock, all right? And we'll look at some standard deviations. And I'll show you how I calculate standard deviation. Apple. Everybody loves Apple. Monsanto. All right, see, that's different, all right? All right, Monsanto. You know, I think I said this last time. I wrote a negative piece on Apple for TheStreet.com, and never in my life have I felt so insulted as I was by these Apple people that basically ripped on everything except the article itself. It was pretty funny. All right. No, I mean they were saying things about like my mom. I mean, it was unbelievable. I was like, what did my mom ever do to you? So here we are, December. I would probably, this late in, I would use maybe a little blended bit of November if I was doing a calc for vol. But just for ease of use, I'm going to use only December. So we're looking at Monsanto, and we notice the vols are around 30, 35 and a half. All right? And we want to know what the standard deviation is going to be for the next 30 days in December. So we'd go 30 over 365 square root times 0.355. Remember, implied vol is a percent, so it's actually 0.355. And then we'd multiply times our price times 62.82. So the Monsanto, over the next 30 days, will probably move less than $6.40 in either direction. Okay? Kind of interesting. All right, any questions on that? Someone said do that again. Yeah, the calculation's real simple, okay? We'll do Apple this time, okay? We're looking at December. We want to know what Apple volatility is going to be over the next, over the next 30 days, okay? Well, the D's, 320s, we'll just use that. 20, implied vol 2740, 2705. You take the mean of that, it ends up being about 27 and a quarter. All right, so 30 days divided by 365 square root times my vol, which is 0.2725, times my Apple price, times 318 and a quarter. So we're expecting Apple to move plus or minus 24 bucks, or less over the next 30 days. All right, pretty simple, actually. All right. How do I find the vol? It's right here where it says implied vol. Okay. Someone said, isn't there a tool that can be read like a gauge in a cockpit that just gives us the info without having to manually calculate it? Yeah, there are. I think Thinkorswim, what you can do, see they've got this range thing. All right, this is supposed to represent standard deviation, but the whole thing is I think it's important to understand how the calculation itself works, okay? You ask a pilot may not be able to rebuild a plane, but he sure knows how the aerodynamics of those wings work. All right, he's not just in there. He understands that if you dive, you're going to get lift underneath the wings, and you need to understand that. All right. Now, Thinkorswim does have this thing. So if I want to see what vol's going to be 30 days in the future, I could just set based on the IV. This will tell me. Here's 30 days in the future. Here's December 4th. And here's the range. You want to set this to 66%, and that'll give you the range. Whatever. Yeah, there you go. That's kind of your standard deviation right there. It's like 67%. I don't think Thinkorswim's it's based on the same calculation. Yeah. Yes, that does. Someone's asking, standard deviation is about 68%. 68, 67, 66. Yeah, that does hold for options. Okay? All right. All right, from current slide. So yeah, I was actually about to answer that. All right. So, expected range is really about 2/3 of the time. So one standard deviation in a stock is supposed to represent about, 2/3 of the time. All right. So if when I said probably, all right, what I really mean is 2/3 of the time, that stock is going to end up within this range or greater. So in Apple, we came up with that $24 number. All right. 2/3 of the time, Apple will move $24 and change or less. Okay. And then now two standard deviations, two variances, represents about 95% of the time. I think it's 95.2. All right, 95.1. Okay. What is the formula for two standard deviation? One standard deviation times 2. Okay. Pretty simple. So a standard deviation is a standard deviation. So you've got one standard deviation, 24, whatever. Two standard deviations, 49 and change. Okay? Because it's just that 2480 number times 2. All right? And so that is what we're dealing with. But is that really what we're dealing with? Okay? And the answer is no. All right? This is where every other educator stops with volatility. Okay? This is where everybody else kind of fails. I don't know if it's lazy. I'm not sure. All right? But here's where we begin. All right? But there's much more to volatility than simple volatility and standard deviation. The problem is volatility is not one-dimensional. It is multidimensional. Okay? Now, think about this, all right? Anybody ever play those slot cars when they were a kid? Or, anybody a skateboarder here? Or even, I still like slot cars or a scooter, something like that. The thing about all those is that they're two-dimensional, okay? They go slot cars. I love slot cars. I do. All right? They're two-dimensional, okay? With a slot car, for instance, you press that button, cranking up the electricity, and it goes faster, all right? You slow down the cranking, and it goes slower. All right? Well, now imagine that you crank on that slot car, and different parts of the electricity moves to different parts of the car differently. Okay, so the left front wheel picks up more electricity than the back rear wheel. Okay, I bet you it'd make dealing with that slot car race a lot more difficult. Okay, same thing with driving, I guess. You slam on the gas. All right, imagine a situation where power on a flat surface went to the wheels differently. It'd make driving really difficult. Now, make power go to the wheels differently, and put it over a hilly and valley-y terrain. Okay? That's volatility. All right? Volatility is multi-dimensional. All right? First thing we're going to talk about is skew. All right? Skew causes options to have a non-normal distribution. All right? That's a game changer. All right? Every strike has a different standard deviation. Okay? So imagine this. All right? When you draw a standard deviation, all right, the lower the vol, all right, the tighter the range, right? So let's say we've got a stock trading 100. And this is its range at 100. All right? And the IV here we'll call 20. Now you've got a strike down here at 90, okay, that has an IV of 30. All right? Well, now what's going on there? Well, it's going to have a much slower slope. Okay? Then you've got a strike trading 110 and an IV of 10. Well, how's that going to look? Well, it's actually going to have a steeper slope. All right? So if you put all of these together, all right, how is that going to change the probability distribution? Do you think that's going to have a profound effect on kind of the way volatility is put together? You know, how this stuff is going to function? The answer is yes, right? You end up with something that kind of looks like this. All right, this isn't exactly it, but it kind of looks like this. All right? Yeah, you've got a non-normal distribution. And that's the problem is options have a non-normal distribution. And this non-normal distribution changes based on volatility. And that change in the non-normal distribution can allow a trader to really clean up. Okay? Savvy traders can make opportunity out of this type of distribution. All right? All right, now term structure. Here's another thing. All right, notice something here. All right, what do you notice between these two between the vols on these things? Smirk versus smile. I like it. Yeah, well, put vol higher. No, the back month vol is higher. Okay, they're both puts. All right, one's November, one's December. Okay, and so you've got this thing that comes up that's kind of the skew structure, the term structure of the trade. All right, so let me show you this. You know, going back to yesterday, which is just a classic example of how traders can take advantage of this stuff. All right, here's RUT. All right, and we're going to go to, yeah, back month vol was high. Exactly. And, you know, think about this. All right, how many guys out there are constantly quoting the VIX? Okay. Well, the VIX is doing this. The VIX is doing that. The VIX is doing this. The VIX is doing that. Yeah. You hear a ton of it. Okay? Well, let's go back to when December was 59 days out. All right, and then we'll look at SPX. All right, what do you notice here? All right, November, you know, if you look at just these two vols, December is 2 points higher than November. Now, where was the VIX on this day? The VIX was at about 19.09. So if you were looking at the SPX, you would say, you know what? Yeah, you would look, if you were going to do, let's say you were going to do a 59-day condor, okay? Do you think that 19.5, if you looked at 19.5, you would think it was a good vol to sell? No, the VIX is trading 19, right? But, you know, and let's say vol was moved, the realized vol was 18.5%, okay? But what if you were selling 2163 vol, all right? That's a full 2.5 points higher than the VIX. I don't know about you, but that might actually be an okay sale. And the truth of the matter is that in a couple of products, not so much this one, that condor sale worked out really well. All right, but now I digress. Let me get to what I want to show here. So here we are on the 2nd, and here's RUT. Okay, And on the second, you can see we've got, and I'm literally going to make 4 of these so that you can see Nov and Ds. Now notice November way higher than December. All right? That's a vertical, isn't it? Why? Well, QE2. QE2. All right? November was way higher because QE2. So I watched a student buy this exact spread for $9.05. It's a huge vol premium. All right? Well, we come in the next day. All right? All right? And we watched this thing collapse. And actually, midday, this is closing prices, so it throws off. She sold this thing at around $9.70. You guys like making 65 bucks in a day on a trade? Yeah, backwardization would be the term. Yeah, we've got this thing called contango and backwardization. You know, you guys like making $65 in a day on a calendar? It's not a bad return, right? 7.5%. Okay? She got out. Now, here's what the foolish trader does. Holds it one more day. And then loses everything they made and more. Yeah. Oh, yeah. That's what they did. They sold the front month and bought the back. And that was what we call term structure. The trader understood that the front month was a little overpriced and actually took advantage, all right? The fact is every month has its own distribution. Every month has its own skew. Every month has its own distribution. I know it's really crazy, but it's the truth. It's the way it is. You know? Kind of crazy. All right, I was just showing you yesterday. And, you know, another example, I'll show you one more example of yesterday gone right and wrong. All right? Let's pull up SPX. All right? This is a trade that I knew they had on. They had the 1185. Oh, yeah, this is the trade I had on, actually. You know, this is something I was working on in my risk profile in SPX. Yeah, because I reverse Harvey'd. One second here. You know, this was a trade that we kind of had on. I'll be interested to see how it looks, actually. Okay? You can see yesterday, all right, when we closed at around 1190, this trade was up massive amounts of money. Today, you know, gave back $1,000. All right, and that was because I didn't pay attention to this trade because it's paper, and because of volatility. Okay. Now, summary. All right, this is just the tip of the iceberg when it comes to volatility. All right, traders that do not understand it backward and forward are at an extreme disadvantage. All right. Now I'm going to kind of pitch to you my my little class that I'm doing. This is through Trade Monster. All right. Class 1, it's going to be understanding volatility, skew structure within a month, between the months, and how the volatility affects the Greeks. Okay? We're going to really dig into volatility, and you're going to understand it over 90 minutes, okay? Backwards and forwards. All right? implied vol, historical vol, every single kind of intricacy, all right? Then we're going to get into how to use volatility to help you improve your trading, okay? Can it help you pick a condor or butterfly? Some topics that I've talked about here, but in much greater detail, okay? Then we're going to talk about implementing volatility to better manage by the Greeks and to choose the right adjustments. There's a lot of people out there using that term, managed by the Greeks. It's a real sexy term. You know what? I want you guys. Hello.
Welcome to GoToWebinar, Web Events Made Easy.
1 second. All right, can you hear me now? Better, okay. All right. So, we're going to really break down, okay, how you can use volatility to manage by the Greeks. You don't really want to manage by the Greeks. It's a real sexy term. But if you don't understand volatility, you're not managing by the Greeks. All right? You're managing by what a model says the Greeks will be. You're using volatility to help you manipulate what the Greeks are doing. Okay? Will actually help you forecast what your profitability will actually be and may actually be. Okay? And then using volatility to help a trader make the decision to stay in a trade or close it. All right? And then I'm going to hit you up with a little bit of a test. And we're going to talk about VIX and VXX some more as well. By the way, did any of you guys short the VXX when I said I would short the VXX? I don't know how many of you guys were there. Any of you guys? Please say yes. I'd love it if you guys made some money at doing that. Nope. Yes? Good. Bought puts. Good. I'm guessing those worked, right? Yep. Yeah, let's, just kind of briefly, I did that presentation, I want to say, on, no, do not know that. Yeah, I want to say that I did that when, I don't know, when was I here? Was it the 2 weeks ago, right? Well, let's take a look at where the VXX was 2 weeks ago as far as the options go. And this is kind of goes hand in hand with understanding volatility. All right, got to think back. And one of the positions I have on, let's put it back to, what was I, the 19th? Yeah. I think we were trading around here on the 19th or the 18th, something like that. And I said, oh yeah, I would absolutely get short VXX. And I think I suggested buying the 2012 puts. Well, if you'd kind of listened to me and you bought the 15 puts for $550, okay? Look at this thing. Just got crushed. And those 15 puts, that's a nice return. 20, up what? $1.75 in 2 weeks. And I just FYI, it did cut down that position that I have, but I still have more. I'm actually going to take all of it off until it splits, and then I'll probably get back in. Okay? All right, now, all of these things are really important. We're going to cover all of it. Okay? And I'm not going to hold a single thing back. All right? Now, the deal I have with TradeMonster is if you open a TradeMonster account, you get the entire price rebated. Okay? If you're already a TradeMonster customer, I can give you a discount. You just got to call me, 888-TRADE-01. If you sign up for Option Pit, all right, any of their services, all right, save level 1, save the monthly, the pit report one. If you sign up for our level 2 future professionals course or our pros course, I'll put the whole credit of the class against it before the end of the new year. All right, before the end of this year. So if you sign up before December 31st, you can actually get all your money back if you open a TradeMonster account and $300 off of a level 2 membership to Option Pit. All right, this is going to be a really good series, and I'm really not going to be holding anything back. Now, Chris, when he and I were talking, he said, well, Mark, you know, you've got to bring a deal to the Option Club. And I said, okay. So, Option Club special. All right, this is for the Option Club only. All right, use coupon code OCTMVOL. All right, and you get 10% off. All right, so that is the deal. All right, that is the Option Club deal. So you'll get, if you sign up, you know, and here's the neat thing. If you sign up and you get your 10% off, I'll still give you the $2.99 against level 2 membership. All right, this is going to be really great. You can go to optionpit.com/event/TradeMonster, or if you're looking for it on the main web page, all right, come on. All right, and I'll log out. And you go to the events page. It's right here. All right. It's kind of cool, you know, if you have any questions or anything. And incidentally, if you haven't been to the website, the blog, you know, I went through exactly how, like that front month trade worked out. Okay. And I do a lot of different things, gamma scalping, you know, different types of stuff there, and you know, it's just a good way to really find out about what we do. All right. The other thing is I do this free AM pit report every morning. It's free to the world. You know, I do a couple of live trades all the time, and we just kind of look at them and talk about them and manage them. All right. So on that note, do we have any questions or comments or thoughts? Preferably your thoughts would be good. All right, if you need a copy of tonight's slides, my email is mark@optionpit.com. All right. Do we have any questions? How much more money, how much more leverage money can we make with vol-based trading? You know, that's really hard, but regardless of how much money you're making now, every trading should be somewhat vol-based. So if you're doing well, understanding volatility will make you better. If you're doing poorly, understanding volatility can maybe help you do not poorly. I do not put numbers on anything, all right? Because being successful is extremely difficult, and it's something that kind of depends on you as much as understanding the content and the base, all right? But here's what I can say is it will certainly make you a better trader, even if you don't use vol-based trading. All right? Well, I hope that based on option volume and heavy open interest, can you predict some inside news going on? I muted myself. If someone just mentioned that this is too advanced for them, all right? If this is too advanced for you, you need to make it not too advanced for you. That's really important, all right? There are some who always know something and leave some hidden footprints in option volume. Yeah, I think so. And I do a lot of paper reading. I write a column for TheStreet.com, and my column is almost exclusively about reading paper. But volatility, can kind of give you some insights as well. All right. So yeah, Mark at OptionPit.com. Email me, and I'll be happy to go through it. And in paper can kind of help you determine, if volatility is the output, then paper is the input, right? And that's kind of one of the things that I'm actually really good with. I think anybody that's ever dealt with me will tell you that one of the things I'm pretty good at is kind of picking apart what a customer is trying to do when he does an order. I have a really pretty good return rate on over at the Street. Well, someone's asking, will we knew enough to learn volatility-based trading without delta-based? Volatility and delta are interrelated. All right, so you can't learn one without the other. But my basic thought process is that nobody out there teaches volatility right. A lot of books teach delta-based trading, which really delta-based trading and volatility-based trading are the same thing. Delta is based on volatility, right? So what is my opinion? Let's put it this way. Delta neutral trading and volatility are kind of the same thing, okay? But I don't think that it makes a lot of sense to do delta neutral volatility trading unless you're getting an edge, okay? Two-pair trading, I do like two-pair trading. But you'll learn enough about volatility so that you could have a pretty good you'll at least be ready to get into trading delta neutral. All right. What I tell people, I understand what two-pair trading is. That actually, you'd probably have some decent. That's good stuff. I may have, John. One second. You'll learn enough about volatility that you can pick up any book and actually understand what it's talking about when it talks about volatility. And from there, you can basically do anything. All right? The key to understanding options is volatility. Everything else depends on that. Delta, gamma, vega, they all depend on volatility. The model bases everything on what volatility you put into it. Okay? Now, someone's asking about someone's asking, can you make money buying a straddle and gaining money about 3 weeks before earnings until earnings day? You can sometimes. Sometimes not. All right? There's any good book suggestions? Yeah, I've got a bunch of them. Shoot me an email. I'll send you my book list. Yes and no. It really depends, because sometimes an increase in volatility is actually a lack of decay. And I actually talk about this on my blog, all right? It's definitely worth reading. Well, the sessions will be recorded, and I'll actually send them to you via CD after we're done, okay? So Mark at OptionPit.com is my email. So I'm actually going to email you my the entire set, and I'm actually going to set up I'm going to try and set up an environment for it as well. Yeah, someone was asking about straddles ahead of earnings. That's a real interesting subject, and that's something I'll really get into. I'll happily get into during the volatility seminar. You email me. Yeah, email me. I'm not going to have. Shoot me an email requesting the book list, and I'll happily send it along. All right. And yes, the sessions will certainly be recorded. Mark at OptionPit.com is my email. All right, any other questions, comments, thoughts? All right, the class itself is a can't miss. all right? And you really kind of need it, and it'll really help any kind of book reading be valuable to you, all right? And like I said, I gave you guys a discount, and you can get it back about 5 different ways or even double it. So hopefully I'll get a couple of you guys in that class, all right? I want to say thank you, and, you know, it's always a pleasure being here, and I'll be back pretty soon, all right? On that note, I will let you guys go.